Some investors are quietly retiring early on monthly dividends, while others holding the exact same ETFs are losing money without even realizing it. And it's not luck. It all comes down to three forces almost nobody talks about: NAV erosion, reverse splits, and whether those dividends are actually sustainable in the long run. Because the truth is this: two people can buy SPYI or QQQI on the same day, at the same price, but end up with completely different results depending on how these mechanics play out. So, in today's video, we're breaking down what's really happening under the hood, and how to make sure you're one of the investors who actually benefits from these monthly paying ETFs, not the ones left wondering why their balance keeps shrinking. Hey investors, welcome back. Today we're doing a full, no stone unturned deep dive into NEOS investments, who they are, why their covered call ETFs like SPYI and QQQI have exploded in popularity, how they think about this crazy income ETF landscape, and what's coming next with their new boosted series and beyond. I'm sitting down, virtually, with Troy Cates, co-founder and managing partner of NEOS Investments, and I'm turning everything he shared into one long-form, easy-to-follow monologue so you can watch, learn, and decide if NEOS belongs in your portfolio. Let's roll. The NEOS origin story. Why this team is different. NEOS Investments is a little over 3 years old. We launched our first 3 ETFs in August 2022, but the team has been together for nearly 2 decades. My partner Garrett Paolella and I have worked side by side for almost 18 years straight. We started on the sell side, moved into asset management, built one of the very first option-based ETF platforms in the industry, grew that business, sold it to a large international manager, and then ran their entire US ETF division for several years. After that, we spent time on the hedge fund side, running option overlay strategies for ultra-high net worth families, pensions, and endowments. That experience taught us exactly what sophisticated investors want from options: tax efficiency, transparency, and flexibility. When we saw the active ETF space, especially the option income side, starting to explode again, we knew it was time to come back and do it our way. That's why we started NEOS. We brought in people we've worked with for 5, 10, even 15 years across trading, research, operations, marketing, and business development. Today we have over 30 people in our Connecticut office, 13 live ETFs, and several more in registration. Our philosophy from day one has been simple: slice up the asset allocation pie, and give investors clean, tax-efficient, high-conviction option income building blocks for every sleeve of their portfolio: equities, fixed income, cash alternatives, crypto, gold, real estate, and more. The first 3 ETFs, the foundation of NEOS. When we launched in August 2022, we didn't want to come out with 20 random funds. We wanted a thoughtful foundation. 1. SPYI, S&P 500 with a covered call overlay, our flagship equity product. 2. BNDI, core aggregate bond exposure with an option overlay. 3. CSHI, ultra short, 1 to 3 month T-bills with an option overlay, a true cash alternative. That was the base. Then in January 2024 we launched QQQI, NASDAQ 100 covered call, and throughout 2020 series kept expanding. Bitcoin, BTCI, gold, IAUI, real estate, Russell 2000, IWM version, fixed income suite, hedge suite versions of SPY and QQQ, and more. Why SPYI and QQQI became 2 of the fastest growing income ETFs ever. People constantly ask. There are dozens of S&P 500 and NASDAQ 100 covered call ETFs. Why are yours blowing up? Here's what resonates with investors. Crystal clear equity exposure. SPYI owns the S&P 500. QQQI owns the NASDAQ 100. No funny business, no swaps, no equity-linked notes when we can avoid it. You know exactly what you own. Transparent, rules-based option strategy built on index options, not single stock options. Index options give us better liquidity, transparency, and that beautiful 60-40 tax treatment. 60% long-term capital gains, 40% short-term, huge for taxable accounts. We target a specific annualized distribution range: SPYI 10-12%, QQQI 11-14%, etc. And we actually try to stick to it instead of chasing the highest headline yield possible. We actively manage the short calls. We don't just sell at the money calls and cross our fingers. We sell out of the money calls. We vary the notional coverage, 50–100% depending on volatility, and we roll monthly based on a disciplined, rules-based process. That has allowed us to capture significantly more upside than many older, more static covered call funds. Since inception, August 2022 through the most recent data, SPYI has outperformed XYLD, JEPI and several other large peers on a total return basis while delivering a consistent MAV 11–12% distribution rate. And the same story plays out with QQQI versus QYLD and JEPQ. The covered call ETF explosion, over 700 option-based ETFs. Here's the reality in late 2025. There are now over 700 ETFs that use options in some way. Buffered, defined outcome, covered call, you name it. Even if you narrow it down to just S&P 500 or NASDAQ 100 covered call strategies, you still have 30–50 choices. Not all option strategies are created equal. Some funds use single stock options, less tax efficient. Some use swaps or equity-linked notes, opaque and often fully short-term tax treatment. Some chase 20%, 30%, even 50% plus headline yields. Our view: do your homework. The single best equalizer when comparing funds is total return, price return plus distributions. A fund distributing 25% sounds amazing until you realize its total return is only 4% and the NAV is melting away. A fund distributing only 11–12% with a total return of 13–15% and a stable or growing NAV is usually the better long-term home for your money. NAV erosion, over-distribution, and reverse splits. This ties directly into the dreaded term, NAV erosion. When you pay a distribution, the NAV drops by exactly that amount on the ex-dividend date. That's normal and healthy. What's not healthy is when a fund distributes more than it's actually earning from options premium plus underlying return. That's over-distribution, and over time, it destroys the NAV. That's why you see some funds doing reverse splits after a couple of years. The share price gets too low because the total return couldn't support the headline yield. At NEOS, we are obsessive about making sure our distributions are supported by the total return of the fund over a full market cycle. We're not perfect, but that discipline is core to who we are. Who are covered call ETFs? Actually, four. We get this question constantly. Aren't these just for retirees? The answer in 2025 is a resounding no. Retirees and near retirees love them because they can stay invested in the S&P 500 or NASDAQ 100, lower volatility a bit, and generate 10–14% cash flow to supplement Social Security, pensions, or bond income. Younger accumulators are using them too, often reinvesting every distribution to compound at a higher rate than a plain index fund, while still participating in most of the upside. Financial advisors are using them as bond replacements, equity replacements, or portfolio volatility dampeners. There's no one right investor. There's only the right allocation for your goals and risk tolerance. Do we eat our own cooking? Yes. Garrett and I personally own every NEOS product that fits our risk profile, which is basically all of them. We're building the exact portfolio we would want for ourselves and our families. That alignment matters to us. The brand new Boosted series, coming very soon. One of the most requested products we've ever had. Can you give us a little more juice? We listened. We are launching the NEOS Boosted series. Boosted SPYI, Boosted QQQI, Boosted BTCI. These seek up to 150%, 1.5x, long-term exposure to the underlying, not daily, reset-leveraged ETFs. We're achieving the leverage synthetically through options, not swaps, which we believe is more cost-efficient and keeps everything in the option world we know best. No daily reset, designed to be long-term holdings. Higher distribution plus potential for higher total return in rising markets, obviously higher risk in falling markets. Think of it as a risk ladder. Hedge version, SPYI QQQI, lowest volatility, downside protection. Core version, SPYI QQQI, middle of the road. Boosted version, highest potential income, plus, upside, highest risk. You pick the rung that matches your personal risk tolerance. What's next? Long-short equity income ETF. We also have a long-short equity income ETF in registration. This is a quantitatively driven 130-30 type strategy with an option overlay for additional income. Long-short equity is hard, many have tried and struggled. But we're partnering with a world-class research provider and believe this can be a true differentiator in the alternative income sleeve. Final thoughts. How to succeed in this wild income ETF world. If I could leave you with 5 rules for long-term success in the covered call SPYI option income space. 1. Educate yourself relentlessly. There are now hundreds of products. Read the prospectus, understand the strategy, know the tax treatment. 2. Use total return as your North Star, not the headline distribution rate. 3. Match the product to your personal risk tolerance and time horizon. There's a NEOS fund, or 3, for almost every sleeve of your portfolio. 4. Consider turning on automatic reinvestment if you're still accumulating. Compounding those high distributions is incredibly powerful over decades. 5. Start simple and conservative. Dip your toe in with something like SPYI or QQQI. Get comfortable, then expand as your knowledge grows. We're still students of the market ourselves. Garrett and I learn something new every single day, and we're committed to keep innovating, keep educating, and keep putting investors first. That's the NEOS story in 2025, where we came from, where we are, and where we're headed. If you want to dig deeper, head over to neosfunds.com. We have comparison tools, tax guides, distribution calendars, and a ton of educational content. Thank you for spending this time with me today. If you found this helpful, smash that like button, this little puppy already did. Drop your questions in the comments, and I'll see you in the next one. Remember, this is not financial advice. Do your own research. All investing involves risk. Take care, keep learning, and I'll talk to you soon. If you haven't watched part 1 yet, go do that first, because we just covered the full NEOS origin story, why SPYI and QQQI have crushed most of their peers, the boosted series that's about to launch, and the 5 big rules for surviving the 700+ option ETF jungle. Now we're going deeper. The stuff most YouTube videos never get to. We're talking exact market environments where covered calls shine or lag, how to actually reinvest distributions the smart way, what NAV erosion really means, and why it's not always the boogeyman people think. Reverse splits, tax efficiency secrets, and the biggest mistakes I see investors making right now in 2025 with these products. Let's jump back in. When do covered call ETFs actually beat or trail their underlying index? Everyone wants the simple answer. When did these things outperform the plain S&P 500 or NASDAQ 100? Here's the honest breakdown. 1. Flat to modestly up markets. Covered calls usually win on total return. You're collecting 10-14% in distributions, while the market goes sideways or climbs 5-10%. That premium is pure gravy. 2. Slow grinding bull markets. Think 2019 or 2023. Still very competitive. You'll lag the index a little because you're selling calls, but the distributions usually keep your total return close or even ahead in many years. 3. Sharp, explosive rallies. Think March-July 2023 or post-election 2024. You will lag. This is the trade-off you sign up for. When the NASDAQ jumps 20% in 3 months, QQQI is not going to keep up 1-for-1 because some of those calls get assigned or roll at a loss. That's the cost of the high income. 4. Down or volatile markets. You crush the underlying on a relative basis. The premium acts like an airbag. A 15% market drop might only be a 5-8% drawdown in SPYI or QQQI because you've been collecting premium the whole way down. Bottom line, if you believe we're in for more of the same, higher volatility, slower growth, bigger drawdowns than the 2010s, this strategy was literally built for that environment. The truth about NAV erosion and why it scares people unnecessarily. I see comments every single day. Look at this chart. The price is going straight down. NAV erosion. Let's clear this up once and for all. When a fund pays a 0.50 distribution, the NAV drops exactly 0.50 on the X date. That's not erosion. That's accounting. You got the money in your account. True erosion only happens when the fund is over-distributing, paying out more than it's actually earning from option premium plus underlying return. That's when the NAV keeps sliding even after you account for distributions. NEOS is religious about not over-distributing. We set an annualized distribution target, 10-12% for SPYI, 11-14% for QQI, etc. And we stick to it because we want the total return to support it over a full cycle. Contrast that with some funds chasing 30-50% yields. They have to reach way out the risk curve, sell closer to the money calls, or use return of capital gimmicks. Eventually the math catches up and the NAV melts, That's when you see reverse splits. Speaking of reverse splits, cosmetic or red flag, a reverse split is just arithmetic. 10 shares at $5 become 1 share at $50. Your dollar value doesn't change. But in the option income world, frequent reverse splits are usually a symptom of chronic overdistribution. The fund couldn't support its headline yield, so the price kept collapsing. At NEOS, we have never done a reverse split, and we have no plans to. We'd rather dial the distribution down a hair in a low-vol environment than destroy the NAV to keep a sexy headline number. Tax efficiency, the silent wealth killer, or builder. This is the part almost nobody talks about, yet it can be worth 2–4% per year in taxable accounts. Most older covered call funds use single stock options, ETF options, or swaps, 100% short-term capital gains, taxed like income. NEOS uses index options wherever possible. Section 1256 contracts, 60% long-term, 40% short-term tax treatment regardless of holding period. That single difference can save high-income investors thousands of dollars a year. It's why you see so many doctors, lawyers, and business owners piling into SPYI and QQQI in taxable accounts. How to reinvest distributions the smart and not so smart way. You have 3 main choices when that monthly payday hits. 1. Full drip, automatic reinvestment, best for accumulators under 55–60. Compounding at 11–14% is insane over decades. 2. Partial cash, plus partial reinvest, common for people in early retirement. Take a little for lifestyle, let the rest keep growing. 3. Harvest all distributions and manually allocate elsewhere, advanced move. Some people pull the cash and buy individual growth stocks, real estate, or whatever they're overweight on that month. My personal rule, never let it sit in cash, earning 0.1%. If you don't need the money today, put it back to work immediately, either in the same fund or somewhere else you love. The Boosted Series, Deep Dive. Why 1.5x and not 2x or 3x? Everyone keeps asking, why only 150%? Why not go full TQQQQ ProShares 3x? Because we want these to be long-term holdings, not casino chips. No daily reset, no decay drag in sideways markets. Built synthetically with options, our specialty. Potentially lower cost than swap-based leverage. Monthly roll. Same cadence you're already used to with SPYI QQQI BTCI. Think of Boosted as the I'm bullish but not reckless sleeve of your portfolio. The most dangerous trend I'm seeing in 20,000, I'm seeing den do 40 to 25 and 45. People taking out HELOCs, personal loans, or maxing margin to buy more income ETFs. Listen, I get the math. 12% yield on borrowed money at 7–8% feels like free money. Until the market drops 20% and your broker calls the loan. I'm not your dad, but please, only use leverage you truly understand and can sleep with during a crash. Final checklist before you buy any covered call ETF in 2025. Ask yourself these 7 questions. 1. Do I understand exactly how the option strategy works? 2. Is the distribution supported by total return, or is it return of capital smoke and mirrors? 3. What's the tax treatment in my account type? 4. How does it behave in a 20% drawdown? Check 2020 don Saktori Bunbadi di Watermensensektor Bodigoni 5. Am I buying for income, total return, or both? 6. Am I over-allocating just because the yield looks juicy? 7. Would I still own this if the distribution got cut in half tomorrow? If you can answer all 7, honestly, you're miles ahead of 95% of investors jumping on the latest 50% yield meme fund. Closing thoughts. 3 years ago, Garrett and I started NEOS because we were tired of seeing investors get sold overly complex, tax-inefficient, or unsustainable option products. Our promise was simple: build clean, transparent, tax-smart income vehicles that we would put our own money, and our family's money, into every single day. That's still the promise in 2025, and it'll be the promise in 2030. Whether you end up in SPYI, QQQI, one of the boosted funds, or even decide NEOS isn't for you, just keep educating yourself. The option income revolution is still in the early innings, and the investors who take the time to understand the details are the ones who are going to win over the next decade. Thank you for sticking with me through this monster two-part series. If it helped even one of you make a better decision, it was worth every minute. Hit that like button if your puppy hasn't already. Drop your biggest takeaway or question in the comments, and I'll see you in the next one. Remember, not financial advice. Do your own homework. Invest with your head, not just the headline yield. Take care, talk soon, and keep crushing it out there. Here's the complete, concise summary of everything covered in the full NEOS Investments Deep Dive, both parts combined. Who NEOS is, founded in 2022 by Troy Cates and Garrett Paolella, team has worked together 18 years. Previously built and sold one of the first option-based ETF platforms, then ran a large manager's US ETF business. 13 live ETFs, 30-plus employees in Connecticut, several more funds in registration as of DES 2025. Core philosophy: slice up the asset allocation pie with clean, tax-efficient option income building blocks. Use index options whenever possible. 60/40 tax treatment, Section 1256. Distributions are intentionally set at realistic sustainable levels, 10–14% range, instead of chasing headline 30–50% yields. Flagship products everyone owns: SPYI, S&P 500 plus covered calls, 10–12% target. QQQI, NASDAQ, 100 plus covered calls, 11–14% target. Full current lineup, DEC 2025, equities, SPYI, QQI, IWM Russell version, single stock versions, fixed income, BNDI, core bonds, TLTI, longer duration, cash alternative, CSHI, 1–3-month T-bills, plus options, alternatives, BTCI, Bitcoin, IAUI, gold, real estate, hedge suite, SPYH and QQQH, downside protection versions, coming very soon. Boosted series, up to 1.5x versions of SPYI, QQQI, BTCI, no daily reset, built with options. Key advantages versus most competitors: index options, better liquidity, plus huge tax advantage, rules-based but actively managed short call strategy, captures more upside than older static funds, no swaps or equity-linked notes when avoidable, cleaner and more tax-efficient, total return first mindset. Distributions must be supported by underlying performance over a cycle. When covered calls shine versus lag, shine, flat, choppy, modestly up or down markets, premium acts as airbag. Lag, sharp, explosive bull rallies, you give away the very top. NAV erosion and reverse splits, normal NAV drop on X date, NAJR are healthy. True erosion, ARJR overdistribution, leads to collapsing price and eventual reverse splits. NEOS has never reverse split and actively avoids overdistribution. Who these funds are actually for: 2025 reality. Retirees, sheer near retirees, wanting 10–14% cash flow with lower volatility. Younger accumulators reinvesting distributions for higher compounded growth. Advisors using them as bond replacements or volatility dampeners. Taxable, account investors loving the 60/40 treatment. Upcoming launches: boosted SPYI, QQQI, BTCI, up to 1.5x long-term leverage via options, monthly roll, no daily reset. Long-short equity income ETF, 130 maser insers 30 maser 130, enter don, kensardan, 130 down, Panzigdal plus option overlay. Troy and Garrett's personal rule: they personally own every NEOS product that fits their risk profile. Eating our own cooking. Final investor takeaways, the 5 rules. 1. Total return is the only true equalizer. Ignore headline yield. 2. Understand the exact option strategy and tax treatment. 3. Match the product to your real risk tolerance and time horizon. 4. Reinvest distributions if you're still accumulating. Compounding is brutal at these yields. 5. Educate yourself relentlessly. There are now 700 option ETFs. Most are mediocre or dangerous. That's the entire NEOS story, as of December 2025 in one tight summary. Clean, tax-smart, sustainable, high-conviction option income. Built by a team that's been doing this longer than almost anyone else, and actually uses the products themselves.